Hello and welcome to the Scan the Markets webinar with myself, David Madden. I'm a market analyst at Equity Capital here in London. And Equity Capital is a part of the overall equity group, including Equity Nigeria and also Ftse in Kenya. Now, what I'll be doing for this webinar is I'll be doing a run through on a handful of the popular big macro markets. And then after that, I'll be kind of throwing it open to any kind of questions or comments you might have, or any markets that I haven't covered. Feel free to just type in the kind of comment section or the question section and just say, would you mind please looking at this? If you do have any questions for me while I'm on a particular chart, for example, I'm looking at the gold chart now. If you do have any questions for me while I'm in the middle of a particular chart, feel free to just kind of say, oh, would you mind commenting on this? But if you have a question not relating to what I'm talking about or covering right then and there, please leave that to the end. There definitely will be time to ask questions at the end. To be honest, at the time at the end where I ask questions and ask to look at various markets, that often runs for longer than the actual scanning of the markets themselves. So the first chart I'm looking at here is gold, and gold, like many markets in the last, well, to be honest, week or so, has seen a huge amount of volatility. It was only about a week ago we saw gold in a multi-week high. And since then, around this time last week, we heard from Jerome Powell, the head of the Federal Reserve. He issued quite a hawkish update last week, gave a pretty clear indication that the Fed are planning to hike interest rates by 50 basis points, 0.5% at next Wednesday's meeting. Now, this wasn't exactly new news, but it seems to me as that the market finally kind of thought, right, this is happening, this is going ahead. We saw a sharp rise in the US dollar recently. I will be covering dollar crosses in the next couple of charts. So gold is traded in US dollars. If you see a strong dollar, that tends to put downward pressure on gold. That was one of the reasons why we saw a sharp move to the downside in gold. Also, what's going on is, even though sadly the war in Ukraine is still going on, we haven't had much of a continuation or an advancement in the kind of economic war between the West and Russia. So for the time being, there's been no major sanctions slapped on Russia for now. That might change, but whenever we have a heightening in the kind of economic war between Russia and Ukraine, that tends to weigh on stock markets. But because we haven't had that, there hasn't been, we haven't had, because that hasn't happened, there's been kind of an absence of demand for low risk assets such as gold. So a kind of combination of a strong dollar and the fact that things haven't really got from an economic war point of view gotten any worse between Russia and the West, that's contributed to a sharp sell-off seen here in gold. We recently kind of fell back to levels last seen several weeks ago, back to levels last seen in kind of mid-February. So we're talking basically 2-month low being set in the gold market. So that really kind of highlights how bearish the move is. While gold continues to hold below these 3 simple moving averages here, it's likely the more medium-term downward trend will continue. If we do move lower from here, we could have to retest 1871, and then break below that could see us back down towards 1844. Looking at the price action in the last, say, 8 to 12 hours, we have seen a rebound in gold here. Actually, on that note, I must point out that I'm actually looking at a 4-hour chart. All the charts I've been looking at are 4-hour charts. And these moving averages that I have here, this one here is a 20-period moving average, the 50-period moving average, and the 100-period moving average. So we can see that gold has been moving higher in the past 8 to 12 hours. But it's worth noting, even though we've rebounded, we haven't even gotten anywhere close to retesting these peaks along here, or we haven't even gotten anywhere close to retesting even the 20-period moving average. So you can almost gauge how weak a market is by how to be honest, how weak the bounce backs are, the rebounds are. As you can see here, the downward moves have been quite aggressive, and on the corresponding upward moves have been fairly short-lived, suggesting there really isn't much buying appetite in the markets overall, adding to the view that gold is in a bearish trend. Now, if we do see a continuation of this upward trend, because let's face it, momentum has swung on the MACD indicator from ever so slightly being in negative territory to ever so slightly being in positive territory, indicating that the bulls are now in control. If we do see a continuation of this short-term rally, resistance might be encountered around 1906, and a break beyond that could see a target 1918. I mentioned a moment ago about the strong US dollar. Last week I said we've had a very hawkish update from the US Central Bank, or sorry, the head of the US Central Bank, Mr. Jerome Powell, gave it quite a clear indication the Fed might look to hike interest rates by 0.5% at next week's meeting. So we've had a very strong US dollar across the board. In addition to that, the kind of ongoing war in Ukraine has kind of been chipping away, at certain kind of confidence indicators across Europe. Earlier in the week, we heard from Germany, the largest economy of the Eurozone, that the GfK Consumer Climate Report fell to its lowest level on record. Think about that. It was even lower than the low levels we saw at the height of the lockdown. It was even lower than the levels that we saw during the kind of 2008, 2009 banking crisis. So there's been growing fears that Germany and many other Eurozone economies, which are reliant on Russian gas, are slowing down. So we've seen a weak euro, we've seen a very strong US dollar. The combination has been a very aggressive move lower in Eurodollar. In fact, Eurodollar in the last few hours today fell to its lowest level in 5 years. So you're talking like multi-year lows. It really underlines how bearish this move is. While we continue to hold below these three simple moving averages, it's likely the recent bearish trend will continue. Moving lower from here, we can look to kind of target 1.0400. Below that, down towards 1.0300. If we go below that, if we could continue on at this rate, we'll probably start hearing calls of parity. Where €1 gets exactly $1 US. Now, it's almost like sometimes these sorts of levels can often act as a magnet at a certain point, whereby if people start, it can be a bit of a self-fulfilling prophecy to a certain extent. If people spend enough time talking about, will we see parity on the euro, something you'll probably see on Bloomberg TV or CNBC TV, or questions being asked in the Financial Times or Reuters or whatever it might be, it's the sort of thing, if that story or that headline gets circulated enough, some people start to kind of think, oh, maybe actually we are going that direction. So if we do move lower, continue to move lower on Eurodollar, don't be surprised if if analysts going on TV and headlines flashing on TV saying Eurodollar to hit parity ? If that sort of attitude and kind of atmosphere takes over. Now, obviously, if you look here at the RSI, the relative strength index, that's firmly in oversold territory, indicating the market's very much overstretched to the downside. Now, the market can remain in overstretched territory for a prolonged period. There's no guarantees that it will snap back. But when the RSI is oversold, it can be, not always, it can be a precursor to a turnaround in the price. Take, for example, the price action that we saw here in early April. We can see here the market moved to, in this case, a multi-year low. We did see a bit of a rebound. The market kind of hung around, but then it moved lower once again. So there's no hard and fast rules, but we're deeply in oversold territory. So that might be a warning. We could see a bit of a rebound, or it could be a case of short sellers might stay away from it. People who want to short the euro against the dollar might say, you know what, it's an oversold territory. I'm not going to short it yet for the time being anyways. And that's the sort of thing which could contribute to euro dollar edging higher. So, and if you do see a rally in euro dollar, where can we go from here? Well, we could potentially target this peak here. It's sort of acted as a bit of a resting point on the way down. That comes into play in around 1.0649, and a break above that could see a target this peak here around 1.0729. What's been going on with euro dollar? Well, we've had, like I said, we've had the kind of overall strong US dollar. The US dollar itself is doing very well. Recently, a couple of days ago, we saw European stock markets and US stock markets fall to multi-week lows. In the last few days, we have seen a risk-off attitude in the markets. The last 2 days, stock markets have rebounded, but overall, a few days ago, sentiment was quite bearish. To an extent, the US dollar is acting as a bit of a safe haven play, in that whenever people are uncertain about the global growth and stock markets are falling, they tend to put their money into assets that typically perform well in that climate. And typically the Japanese yen, for example, does well, or the Swiss franc, or to an extent the US dollar. What's also going on, I don't necessarily think it's going to happen, but the deputy president of the European Central Bank in the last week or two suggested the European Central Bank might look to hike interest rates in July. No, I don't think it's very likely to happen. but it's something that should just worth considering. Listening out to kind of the language and the commentary from Eurozone central bankers is something which could alter, which could easily alter Eurodollar. In fact, the move that we saw here to the upside, I believe this basically 1 week ago, I believe this was the move that actually drove up Eurodollar. In this case, to kind of a multi-day high or a multi-week high, but as we can see, the move didn't last very long. Coming on now to kind of stock markets, we can see here this is the US 500, the S&P 500. What's been going on? I mentioned a moment ago about the kind of overall risk-off sentiment in the markets. What's been driving this? Concerns about high levels of inflation. If the cost of living keeps rising at a very aggressive rate and it outstrips the rate of your pay rise, you're net worse off. So inflation in the US is at a 40-year high. It's not really showing any signs of slowing down. We've already had one interest rate hike from the US Central Bank, the Federal Reserve, last month. There's talk of more rate hikes in the pipeline. There's talk of even larger rate hikes in the pipeline. If the cost of borrowing goes up considerably in, say, a 6-month or a 9-month period, that's kind of adding to people's costs, higher mortgage payments, higher credit card repayments, higher business loans, putting further pressure on an already squeezed economy. In fact, today, we saw some pretty surprising economic indicators of the US. The US economy, according to the advanced reading of US GDP in the first quarter, the US economy actually contracted by 1.4%, negative growth of 1.4%, which is quite worrying, considering that the US economy grew by almost 7% in the final quarter of last year. Now, this is adding to the kind of the notion that we could be in for a recession. Now, when we do or not remains to be seen, but earlier in the week, a couple of days ago, we saw the US 500 fall to its lowest level since mid-March. So we're talking about a 5-6 year low being set on the US market. Now, what we can see here is, I'm not sure, just to clarify, it was negative 1.4% growth for the US GDP that was posted in the advanced reading, which, like I said, economists were expecting 1% growth or 1.1% growth. So it was a big miss on expectations, and it was certainly a big change around from the almost 7% growth seen at the back end of last year. So it's a big difference to go from almost plus 7% to minus 1.4%. So that's been hanging over the markets. Looking at the price action here, we have seen a rebound in the last couple of days, the last 2.5 sessions, but when we have rebounded, the highs you've seen in the last few hours haven't even retested the peak at the end of last week or this particular peak here. Granted, we have managed to retake the 50 period, the 20 period moving average, which we didn't retake here, but still we're well below this recent peak here, and we're certainly well off the peaks that were set only this time last week. So the overall view, is still bearish for the US 500, while the market holds below these two moving averages, the 50 period moving average and the 100 period moving average. I think it's likely the more medium bearish trend will continue. Moving lower from here, we could look to retest the recent lows here in around 41, 42, and then below that could see us back down towards 41.38, and then if you go below that, we could then be heading back down towards 41.06. So keep an eye for these kind of lows here. The low of mid-March and then the low of late February are the areas I've been looking out for to the downside. Now, if we can manage to kind of stage a rally from here, where could we go? Well, we could to target this peak here in around 43.07, and then beyond that, we could look to head back up toward this moving average here, the 100 period moving average. If you follow it around, you can see it acts as support here. It acts as both support and resistance along here. Bit of a consolidation zone here. So what I often say is, if a metric has been of importance in the past, it makes it more likely to be of importance in the future, although there are no guarantees. And the 100 period moving average comes into play around 43.66. So keep an eye for that area there. So once again, this is the 100 period moving average on the 4-hour chart. What's also been going on is that the speculation that interest rates are going to rise at an aggressive rate has hit the technology sector quite hard. Now, to be fair, there are some tech stocks out there like Apple who have hundreds of billions of dollars in cash, and they're they're quite financially secure. But as a whole, the tech sector is relatively highly indebted compared to, say, a more traditional industry such as retail, for example. And with that, if we are to see quite a few interest rate hikes in the next 3, 9, 12 months, in companies and sectors that have relatively high levels of debt, they're more likely to actually be they're more likely to lose out the most. If we have higher interest rates, sure, higher interest rates will affect anyone that is outstanding debt or outstanding loans, but it'll have the worst impact on those who have the largest amount of debt. And the tech sector is a fairly big component of the US 500. And in turn, whenever we've seen chatter about higher interest rates and we've seen US government bond yields rise, it tends to be the Nasdaq 100, the S&P 500, and the Dow Jones in that order getting hit. The Nasdaq being the worst hit, the Nasdaq being the worst hit, the S&P 500 being the kind of second worst hit, because there's still a fair few tech stocks in there. Probably the least worst hit is the Dow Jones. There's something to be mindful of if you're trading US indices. Which indices do you trade? And on certain days, some markets have bigger swings than others. Sticking with equities, we're looking now at the UK 100. So the UK 100, the Ftse 100, like other stock markets, has come under a bit of selling pressure. Only a few days ago, it fell back to a level once again seen about 5 or 6 weeks ago in mid-March. Similar story. Traders are in risk-off attitude. They're dumping equities. What's driving this? Concerns about recession. It's here in the UK, inflation's at a 30-year high. We have continued uncertainty with what's going on in relation to supply chains partially because of the reopening of the global economy from the pandemic. The war in Ukraine hasn't helped the kind of overall European system of supply chains. So this is really kind of a factor of what's going on in relation to the UK 100. As we can see, though, it has enjoyed a fairly large rebound. The peak here that we've seen is back up to the level last seen a few days ago. We're at a multi-day high, which doesn't sound like much, but it's a lot better than what we're seeing in other European stock markets and US stock markets. We've retaken all three of these moving averages. We've actually retaken a large portion of the ground that was lost here. To show you this tool here up the top left, and if you click on this, it'll this crosshair here, it's a good tool whereby you can measure and move. So if you take this peak here all the way down here, we can see the market dropped 355 points thereabouts in this kind of 1 week period. Now, at the same time, even though we've dropped 355 points since then, we've actually pulled back and rallied about 240. So we've pulled back about, say, at a rough estimate, 65% of the ground lost. So we've pulled back roughly 65% of the ground lost. We're back above all three moving averages. We're back to multi-day highs. It seems to me the UK 100 is making a pretty good effort at rebounding. And while the market does continue to hold above these three simple moving averages, I think because the more shorter-term uptrend will continue. Rallying higher from here, I'll be looking up towards this peak here in around this peak here in around 76, 72, and then if you go beyond that, I'll be looking up towards 77.00. Trade period moving average, and then of course, if you're looking to the downside, where can we look to target? Should we see a very large sell-off? 91. Now, if you do see a sell-off, because keep in mind, the shorter-term trend is it's to the upside. It's worth noting that the more medium-term trend is to the downside. If we do see a continuation of this sell-off, where can we look to target? Well, I'll be looking out for the 20-period moving average here. This line here. If you follow it around this green line here, you can see it acted as support on a few occasions along here. It acted as support along here as well. When the market dropped below it, you can see that it acted as resistance along here. A bit of a consolidation zone along here. So it's a fair bit of form when it comes to being a significant metric, be it as a support, a supporting area, or a resistance zone. And as I often say, if a market has been of importance in the past, it makes it more likely to be of importance in the future, although there are no guarantees. So if we do see a bit of a pullback, who knows, we could see some buyers enter the fold, because let's face it, on the much longer term trend is higher, and buying on the dip has been a popular strategy over the last few weeks and months. If we do see a bit of a pullback, where can we find support for potentially in around this area here, around 74.57, and a decent break below that could see us back down towards 73.91. Coming on now to the British pound versus the US dollar. I've already spoken about how we've had the US dollar outperform. The US dollar is driving ahead. We've now seen pound dollar fall to its lowest level since the summer of 2020. So we're talking about not quite 2-year lows, but we're basically approaching 2-year lows on pound dollar. What's been the driving force behind this? Well, as I kind of covered a bit in the UK 100, the Ftse 100 chart, there's kind of murmurs of a recession on the horizon here in the UK. Inflation's at a 30-year high, where there's constant headlines about a cost of living crisis, about how energy bills and the likes are going to go through the roof. There's also fears that, because of the supply chain issues in relation to Ukraine, overall costs are going to rise. It's also worth noting that we actually have an update from the Bank of England next week. The Bank of England probably won't actually hike rates, considering they've already hiked interest rates 3 times since December. And it takes a while for those interest rate hikes to actually trickle down and actually impact the economy. It can often be, kind of 6 months or more before you really see the impact of a rate hike. So you've had 3 rate hikes in fairly quick succession. You don't want to necessarily kind of keep hiking rates and then finding out, oh, they all hit you at once, say 6 months, 9 months, 12 months down the line. So we've seen a very aggressive move lower in GBP USD. Looking here at the similar, like we see in other charts, when we have had a rebound, it's been very, very small. So once again, the fact that it's had a small rebound kind of really highlights how bearish the actual sentiment is, because no one really wants to buy into it, basically. We're well below all 3 of these simple moving averages here. If you continue to hold below those metrics, it's likely that a more medium-term bearish trend will continue. Moving lower from here, we could head back down towards 123, 122, and then 120 will be the next big level to watch out for. Like I talked about how parity and Eurodollar will be the next big level to watch, or the next real big level to watch out for. I think 120 for pound dollar will be the next big level to watch out for. But looking at the price action here, we can see the market has recouped a bit from its lows. Looking at the MACD indicator here, we can see momentum is sort of neutral. It doesn't really kind of suggest, the buyers or the sellers are really in control. Now, looking at these red bars here, as the market was moving lower here, these red bars were quite large, indicating that the sellers were very much in control. Then we saw tapering off in that activity. So that in itself is almost a bit of a sign we could see a bit of a change in trend. So to my mind, price is more important than any indicator by a long way. I'll be much more interested in what the price is. For me, the price tells you what the most about which way a market's going. But sometimes these indicators can be not always, can be a bit of a forewarning for what's about to happen. So if negative momentum is in decline, it sort of indicates that the bears are no longer as aggressive as they once were. If the sellers are no longer as aggressive as they once were, that could mean we could see a rebound. So far, we haven't seen it. And look at this. You can make an argument to say the market, could rebound here. What do we see? We saw yet another leg lower. So in that regard, things are continue to look weak for pound dollar. But at the same time, we're very much in oversold territory for the RSI. There's no guarantees there is going to be a rebound, but I wouldn't be surprised if you do see a rebound in the near term. It could be a few hours time, it could be a few days time. And if you do see a rebound, where would we go from here? Well, perhaps up toward this peak here around 1.26, and then beyond that up toward this peak here around 1.2771. One of the big movers in the currency markets today was the Japanese yen. The Bank of Japan issued a very dovish update. They basically said that they're going to continue their policy of keeping the yield on the 10-year Japanese government bond at kind of 0.25%. And they basically said, we will use unlimited, essentially, we'll use unlimited firepower like government bond buying as a way of keeping it down or keeping it in check, as it were. And the fact that they were so kind of, dedicated to do that, that kind of sent off a very dovish signal. And essentially what they're looking to do is intentionally weaken the Japanese yen to help. And when the Japanese yen is weak, Japan's a big export economy. A lot of good, goods and whatnot are made in Japan and sold elsewhere. The idea is keep the Japanese yen weak, therefore make their exports even more attractive than they already are. So we've seen dollar yen, between the strength of the US dollar and the weakness of the Japanese yen, hit a 20-year high. It's up around, not quite a 131, but it's at around 131. 20-year high that really hammers home how bullish the US dollar is versus the Japanese yen. It also speaks to the weakness of the Japanese yen. We can see here that we're well above all three of these moving averages. While we continue to hold above these three moving averages, it's likely the kind of broader, very strong bullish uptrend will continue. Moving higher from here, for realistic targets, well, perhaps up towards 131, 132, 135 in the more medium term. These are the levels I'll be watching out for to the upside. Now, whenever a market kind of goes through a very strong move in one direction or another, you always have to be a bit mindful of, are we going to see a bit of an aggressive move in the opposite direction? And essentially, what I've often observed over the years is whenever a market moves aggressively in one direction, in this case higher, don't be surprised if it very quickly moves aggressively in the other direction, in this case lower. So if you look at the price action along here, what I would consider to be a more kind of normal growth level or a more normal pattern is if the price action that we saw in this time frame here was kind of almost like at a 45-degree angle, 45-degree gradient. That would be kind of relatively normal levels of moving higher or moving lower if that be the case. But we start to see aggressive moves higher or lower. That can often be a bit of a word to say, well, we're in for a bit of volatility here. So you can even notice how before we hit this new peak, the rate at which the dollar gained the ground against the yen really kind of accelerated. And then what do we see? We saw a lower low, a lower high, a lower low, only to move higher yet again. So the fact that we're not actually having quite an aggressive move higher in the yen once again suggests to me, I wouldn't be surprised if we see a fairly sharp pullback, whereby we pull back a few hundred pips. There's no kind of guarantees that it will or it won't, but it might do in relation to the currency pair. So if I was to look at dollar yen, I'd also be concerned with the fact that the RSI is firmly in overbought territory, which can suggest the market's overstretched to the upside. Keep in mind, the last time the market was overstretched was only about a week ago or 9 days ago. We can see that it was firmly overstretched here. And guess what? That preceded this correction, this downward move. Now, the downward move didn't last too long. It wasn't even too deep when you consider how much ground was traveled along this period and along this ground here. It really wasn't that much of a pullback. But this is what I mean. Visualize the trade ahead of you. So it's possible that we could pull back somewhere back down towards this peak here or this peak here, somewhere in around kind of 129.40, 129.15, thereabouts, 129 itself, or perhaps even down towards where the simple moving average is here, the 50-period moving average in around 128, or even a large pullback could see us all the way back down towards 126.60, which is the 100-period moving average. Keep in mind, we can see here the 100-period moving average acted as support here, and resistance here. So back in early March, it was an important metric, but because the market's been so strong, we haven't gotten anywhere near retesting the 100-period moving average since. So the kind of 129.40, 129.20 area, 128, 126. These are all 126.60. These are all areas that we could have as potential support zone should we see a sharp move lower. So just be mindful of the fact that we're in overstretched territory. Who knows? It could just keep continuing on at this aggressive rate. But whenever you see a very aggressive move higher, don't be surprised if you see a very aggressive move lower. Also, if you're not if you're not familiar with Dow theory, I'll have a look at Dow theory. Essentially, talks about very different typical price patterns you see. and it's not uncommon to see in a strong upward trend, like the most aggressive move can often be towards the end. It's almost as if the last kind of hurrah of the last level of kind of, everyone's kind of piling in. Everyone who hasn't bought the market yet then jumps in, and they kind of bring it to almost an overstretched level. So it's possible that this is the last hurrah we're seeing in dollar yen in the medium term, anyways, in the next few days. So it's before we actually look to pull back. The pullback could be 50 pips, it could be 200 pips. That's yet to be seen, but just something to consider. I've gone through all the kind of charts I was planning to go through. If you have any questions for me about anything I've covered so far, or any markets that I haven't covered that you always take a look at, feel free to just ask away in the chat section or the question section. Like I said, I am absolutely more than happy to look at different markets. I just picked a handful of markets I thought you might be interested in, and a handful of markets that I'm interested in, any kind of big moves, because it was kind of quite the headline when we saw euro dollar fall to a 5-year low, when we saw dollar yen rally to a 20-year high. I know that there's a common theme there, and of course it's the US dollar. It's also interesting to see that the Ftse 100, the UK 100, has had quite a large rebound. That's quite impressive, because you can almost like judge the strength of a market by I'll go back to the Ftse 100 now. You can almost judge a strength of the market by how little it falls when overall markets are falling, and you can also certainly judge how strong a market is, how quickly it rebounds. So when the UK 100 was driven to a multi-week low here, about a 4-week low, a 5-week low here, within a matter of days, it all kind of very, very, very quickly rebounded a few hundred points. So once again, you can almost like judge, like I said, the strength of a market or the weakness of a market by how much it reacts to a preceding move. If there's no more questions coming through, or no questions at all, I'll have to look to wrap things up in the next couple of minutes. But if any questions, now's the time to ask. For those of you that are on Twitter, feel free to contact me, follow me on Twitter. Feel free to tweet at me. Obviously, can't give you any advice, but I can certainly provide commentary similar to what I've been doing in this. My Twitter handle is @dmadden_equity. For those of you who are on Twitter, I also kind of follow and interact with the Equity Nigeria Twitter handle. I also interact and follow the Ftse Twitter handle. So every now and again, I'll see they'll retweet me or I'll retweet them. But I would, I was happy to chat to you on Twitter. If you have any questions for me, @dmadden_equity is my Twitter handle. And once again, I must stress, I can't give you any advice. But if you were to say to me, what do you make of the UK 100? I can happily do a screenshot, do a tweet, take a screenshot of the chart, and talk about the kind of prevailing trend, talk about potential levels to the upside, potential levels to the downside, so on and so forth. Seeing as there are no questions, I'll look to wrap things up there. Actually, I think there's actually one question coming through, so I'll just hold fire. One second now, questions coming in. The US 30 and the Nasdaq 100, they seem to move in the same direction, question mark. Yes, I'm glad you made that observation. I'm glad because it's something I'm a big believer in. I mentioned Dow theory a minute ago. And Charles Dow was a well-known stock market, a famous kind of within stock market circles. a famous stock market chartist and market technician over 100 years ago. The Dow Jones was named after him, and he has Dow theory has several key points. And one of the key points is that the averages must confirm each other. And what that essentially means is that markets that are quite similar to each other should, in theory, be moving in a similar direction at the same time. And so with that, if you're seeing, in this case, the US 30, the Dow Jones, last Thursday it hit a 6-week high, and since then it's been moving aggressively lower. And a couple of days ago, the Dow Jones fell to its lowest level in about 4 weeks or 5 weeks. So it's been moving aggressively lower. Let's take a look at what's going on with the Nasdaq 100. I'll put them side by side so we can compare and contrast. So I talked about how a week ago the US 30, the Dow Jones, was at a peak, and in the last week it's been in a solid downward trend, and it's gone on to hit a kind of a 4-week low or a 5-week low. What have we seen with the Nasdaq 100? Where was the Nasdaq 100 this time last week? It wasn't even at a peak this time last week, but it was off its recent lows. And what have we seen since then? A lower low, a lower high, a lower low. Is this going to be a lower high, or is it going to be a full-on correction? That remains to be seen. But the attitude is still the same. If I look at the price action, we've been moving aggressively lower on the UK, the Nasdaq, the UT 100, the Nasdaq 100 in the past week, and we've been moving aggressively lower in the US 30, the Dow Jones, for the past week. Excuse me. So what I'll be doing in that scenario is, if you're trading, say, either one or the other, be it the US 500 or be it the Nasdaq, the Nasdaq 100 or the Dow Jones, if you're making a view, whatever it is, for example, I'm bearish and I'll sell the rally, or I'm bullish and I'll buy the dip or buy the break higher. If you're trading one and you have a view on one, it's always worth your while looking at what a similar market is doing and see if it's also doing the same thing, because there are no guarantees, and that's why trading is hard. There are no guarantees, but if two stock markets, for example, that are quite similar are moving higher in the same direction at the same time, it's more likely that they're going to keep moving in the same direction at the same time than less likely. Now, things can deviate, but that's ultimately what the view is. And same with if two stock markets are lower, then you think, oh, that stock market, I'm thinking of shorting the Dow Jones, and you look at the S&P 500, you look at the Nasdaq 100, you look at the DAX in Germany, and they're on a downtrend as well. That kind of adds to your view, or it makes it even more likely that your view that a stock market will continue to be bearish. There are no guarantees, but that's what it is. So that's called Dow theory. I strongly recommend reading about Dow theory. I'm a big fan of Dow theory. There's a question here about dollar CAD. I'll have a look at dollar CAD, and I'll look to wrap things up then. So dollar CAD has been moving aggressive. It's been moving higher. Before I kind of come on to dollar CAD, I'll also take a very brief look at oil. Look at the dollar CAD chart here. If you were trading the Canadian dollar at any cross, you must keep an eye on what's going on with oil. Canada is a major has a large oil and gas sector. So whenever the oil price is strong, the Canadian dollar tends to be strong. Whenever the oil price is weak, the Canadian dollar tends to be weak. There are no guarantees, but that's usually the broad idea. Looking here with dollar CAD rather, we can see that that's been moving aggressively higher in the last few sessions. As I mentioned, the dollar is at a 5-year high against the euro. It's at a 20-year high against the Japanese yen. There's a clear picture here of dollar strength. Yet the US dollar is only at a 5 or 6 week high versus the Canadian dollar. So although it's moving higher, although the dollar has been gaining ground against the Canadian dollar recently, it's nowhere near as strong as it is against the euro or the Japanese yen. We can see here that we've hit a bit of a peak here, and then we appear to be moving lower yet again. This is dollar CAD on a bigger chart here. We can see here that the market rallied basically to its highest level in around the first week in March. So we're talking about a 6-7 week high has been achieved. We've had a bit of a pullback. It's not a total surprise. Markets don't move in straight lines. We've had a bit of a pullback, but it's also worth noting though, in the last few hours, we've seen a break higher in oil market. So oil has been gaining ground the last few hours, oil is now at its highest level in a few days, in about 4 or 5 days. So it's no surprise to me that oil's hit a multi-day high, and at the same time, dollar CAD has retreated from its multi-week peak. To see how the two are connected. So the stronger oil market has pushed up the Canadian dollar and in turn moved dollar CAD lower. So when will this, is it going to be a case of the dollar CAD drifted it lower and continues in the more medium term upward trend? Or is it a case of the oil market keeps getting higher and higher and higher, and in turn dollar CAD goes lower and lower and lower? To my mind, while we continue to hold above these three simple moving averages, I would think that the more medium term upward trend is going to continue. Moving higher from here, I'm looking towards 129, and beyond that up towards 129.63, 130. So these are the levels I'll be watching out for to the upside for dollar CAD. If you do move lower from here, where we potentially find support, but perhaps in around this low here, in around 127.70, or perhaps down toward this area here around 127.30. These are the areas that I'm watching out for to the downside for dollar CAD. So I hope that answered your question in relation to dollar CAD. I'll look to wrap things up there. You're more than welcome. Happy to talk about any currency pairs you want me to. As always, I appreciate your time. I know it's late, particularly for the crowd tuning in from Kenya, and also I'm sure the crowd in Nigeria. You have a busy evening lined up as well. I will look to wrap things up there. Once again, I will thank you for your time. Thanks again for asking a few questions, because it's always more fun. It's kind of a bit of interaction on the go. You can join me this time next week for the same Scan the Markets webinar. And until then, if you don't contact me on Twitter, hopefully I'll see you next week. So everyone, have a good evening and speak to you next week. See you, everyone.